Imagine opening your bank account one morning and realizing something has gone terribly wrong. Your car needs an unexpected repair. Your company announces layoffs. Your rent is due. Your insurance bill arrives. And then you check your bank balance. There is barely enough money to make it through the month. No emergency fund, no financial backup, no family member you want to call, just a credit card, a loan application, and the terrifying question, how am I going to pay for this? Now imagine the opposite. Imagine losing your job tomorrow and knowing that your essential bills are already covered for the next 12 months. Not because you make six figures, not because you inherited money, not because you won the lottery, but because you built an emergency fund while earning just $30,000 a year. That is exactly what we are going to break down today. And I'm not going to tell you to simply spend less and save more. I'm going to show you the exact system, how the money was divided, how much was saved, where the savings went, what expenses were cut, what mistakes were avoided, and most importantly, how the system made saving feel almost automatic. Because building an emergency fund isn't really about having incredible self-control. It's about creating a system that makes the right financial decision easier than the wrong one. So if you earn around $30,000 a year and you believe saving a full year of expenses is impossible, stay until the end. Because the number that matters isn't your salary. It's what you do with the money that reaches your hands. Before we begin, if you're serious about building wealth instead of just looking wealthy, make sure you subscribe and turn on notifications. Every week, we share practical money lessons, investing strategies, and wealth psychology that help ordinary people build extraordinary financial futures. Let's start with the reality. A $30,000 annual salary sounds very different depending on where you live. Before taxes, that's approximately $2,500 per month. After taxes and deductions, the actual amount hitting your bank account could be considerably lower. For this example, let's assume the person brings home approximately $2,100 per month. That's about $25,200 per year after deductions. Now here is where most people make the first mistake. They hear the words, 1 year of emergency savings, and immediately calculate 25,200s. And they think, there is absolutely no way. But that isn't the number we are actually trying to save. An emergency fund is designed to cover essential expenses, not your entire normal lifestyle. If you spend $2,100 every month, but only $1,400 of that is necessary to survive, your emergency fund target doesn't have to be $25,200. It could be closer to $16,800. That's 12 months of essential expenses at $1,400 per month. And suddenly, the goal looks very different. This is the first principle of the system. Don't build your emergency fund around your lifestyle. Build it around your survival number. Your survival number is the amount you need to keep the basic parts of your life functioning. Housing, utilities, groceries, transportation, insurance, minimum debt payments, essential health care, and other unavoidable bills. Not restaurant meals, not streaming subscriptions, not shopping, not vacations, not luxury purchases, not things you would immediately stop paying for if your income disappeared. This distinction changes everything. The 3 numbers. Before saving a single dollar, 3 numbers had to be calculated. Number 1, monthly take-home income. Number 2, monthly essential expenses. Number 3, the emergency fund target. Let's use our $30,000 salary example. Suppose the monthly take-home income is $2,100. Now let's say the essential expenses look like this. Housing, $750. Utilities, $150. Groceries, $300. Insurance, $100. Minimum debt payments, $100. Phone and internet, $80. Basic personal expenses, $70. That brings essential expenses to approximately $1,700 per month. 12 months would therefore require $20,400. That's the emergency fund target. But notice something. Income is $2,100. Essential expenses are $1,700. That leaves only $400 per month. And this is where the system becomes important. Because if you simply tell yourself, I'm going to save $400 every month, you may succeed for a few months. Then something happens. A birthday, a car repair, a medical bill, Christmas, a trip, an unexpected expense. And suddenly the savings disappear. So instead of relying on leftover money, the system uses multiple layers. The 5-bucket system. The biggest change was separating money according to its purpose. Instead of having one bank account where everything mixed together, the money was divided into 5 buckets. Bucket 1, bills. This account pays for essential monthly expenses. Bucket 2, emergency savings. This is money that is not touched unless there is a genuine financial emergency. Bucket 3, short-term expenses. This covers predictable expenses that aren't monthly. Car maintenance, annual home repairs, school expenses, and similar costs. Bucket 4, spending. This is the guilt-free money. Eating out, entertainment, clothes, small purchases, whatever fits inside the predetermined amount. Bucket 5, long-term wealth. This is where investing eventually happens, but there is an important rule. Emergency savings comes before aggressive investing. If you don't have a financial cushion, investing every available dollar while carrying no emergency cash can create a dangerous situation. You could be forced to sell investments at exactly the wrong time. The goal isn't simply to make money. The goal is to become financially resilient. The first $1,000. The first milestone wasn't $20,000. It wasn't $10,000. It was $1,000. Why? Because $1,000 changes your relationship with unexpected expenses. Imagine your car suddenly needs a $700 repair. Without savings, that could become credit card debt. With $1,000 sitting in an emergency account, the situation becomes an inconvenience instead of a financial disaster. So the first objective was, get to $1,000 as quickly as reasonably possible. At $400 per month, that would take about 2.5 months. But there was another strategy. For the first few months, temporary sacrifices were made. Not forever, just temporarily. For example, streaming subscriptions were reduced. Restaurant meals were limited. Unnecessary shopping stopped. Unused memberships were canceled. Large purchases were postponed. And every unexpected dollar had a destination. A tax refund, emergency fund. Cash gift, emergency fund. Side income, emergency fund. Unused items sold online, emergency fund. The goal wasn't to become permanently miserable. The goal was to create the first layer of financial protection. Once the first $1,000 was reached, something important happened. The emergency fund became psychologically real. It was no longer an idea. It was money sitting there, and that made continuing much easier. The 48-hour rule. Here is one of the most powerful parts of the system. Before making a non-essential purchase above a certain amount, there was a waiting period. 48 hours. Want a new pair of shoes? Wait. Want a new gadget? Wait. Want to upgrade your phone? Wait. Want to order something because it is on sale? Wait. The purpose wasn't to eliminate spending. It was to eliminate automatic spending. Because many purchases feel necessary in the moment. 2 days later, they suddenly don't. This rule created another advantage. Every purchase became a decision. Instead of, I want it, the question became, does this deserve money that could otherwise protect my future? That question alone can change your finances. The $400 gap. Now let's return to the numbers. Monthly take-home, $2,100. Essential expenses, $1,700. Potential monthly savings, $400. If you save $400 every month, $400 times 12 equals $4,800 per year. But the goal is $20,400. So something has to change. And this is where many financial plans fail. People think, I need to save more. But saving more isn't always about cutting more. There are actually two levers: reduce expenses and increase income. The system used both. Suppose expenses were reduced by $200 per month. Now essential spending becomes $1,500. That creates $600 per month available for saving. $600 times 12 equals $7,200. Better, but still nowhere near $20,400. So the next step was increasing income. Not necessarily getting another full-time job. Small additional income can make a meaningful difference. Suppose an additional $300 per month is generated. Now, $600 savings from the main income plus $300 additional income equals $900 per month. That's $10,800 per year. Still not the full target. But remember something important. The goal isn't necessarily to build the entire emergency fund in 1 year. The goal is to build it systematically until you reach the target. And this is where the timeline changes. The 2-year mindset. One of the biggest psychological mistakes people make is creating financial goals that are mathematically possible but emotionally unrealistic. If your emergency fund target is $20,400 and you can realistically save $900 per month, you're looking at roughly 23 months, almost 2 years. And that's okay, because there is no rule saying your emergency fund must be built in 12 months. The phrase 1 year of emergency savings describes the amount of protection you want. It doesn't dictate how quickly you have to build it. So the system became Phase 1, $1,000 Starter Emergency Fund. Phase 2, 1 month of essential expenses. Phase 3, 3 months. Phase 4, 6 months. Phase 5, 12 months. And each milestone created another psychological victory. At 1 month, you breathe easier. At 3 months, you have serious protection. At 6 months, job loss becomes less terrifying. At 12 months, you have something most people don't: time. And time is one of the most valuable financial assets you can have. Where the money was stored now comes an important question. Where should an emergency fund actually sit? The answer is generally somewhere safe, accessible, and separate from your everyday spending money. For many people, that means a suitable savings account or high-yield savings account, depending on what is available and appropriate where they live. The emergency fund is not money for chasing maximum returns. Its primary purpose is safety and accessibility. Imagine keeping your emergency money in an investment that can fall significantly in value. Then you lose your job during a market downturn. At exactly the moment you need cash, your investment is worth less. That's not what emergency savings are supposed to do. Your emergency fund has a different job. It protects you from being forced into bad financial decisions. It gives you options. The automation system. This was probably the most important part. Saving wasn't something that happened at the end of the month. It happened immediately after payday. Let's say payday is Friday. On Friday morning, money arrives. Immediately, bills money is separated. Emergency savings is transferred. Short-term savings is transferred. Spending money is separated. Whatever remains is available for normal living. The order matters. Most people do this. Earn, spend, 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 and then ask, how much can I save? The system reverses it. Earn, save, protect, then spend what remains. This is commonly called paying yourself first, and it removes one of the biggest problems with saving: decision fatigue. You don't have to decide every day whether you're going to save. The system already decided. The emergency fund was not a spending account. This distinction is critical. An emergency fund is not money I can use whenever I want. It's money I can use when something genuinely threatens my financial stability. So what qualifies? Job loss. Major unexpected medical expenses. Essential vehicle repair. Urgent home repair. Unexpected necessary travel. Other serious expenses that cannot reasonably be covered through normal cash flow. What doesn't qualify? A vacation. A new television. A shopping sale. A new phone because the latest model looks better. A restaurant bill. Concert tickets. A spontaneous weekend trip. If you use your emergency fund for non-emergencies, you're not actually building financial security. You're creating a second checking account. And that's not the goal. The biggest sacrifice. There was one uncomfortable realization. You cannot build a large financial cushion while maintaining every expensive habit you had before. Something has to change. But here's the important part. The system didn't try to eliminate every enjoyable thing. Instead, it focused on the expenses that had the biggest impact. For example, a $5 coffee isn't going to destroy your financial future, but paying for a car you can barely afford can. A $15 streaming service isn't necessarily the problem, but a $600 monthly lifestyle upgrade might be. This is why financial optimization should focus on the big three: housing, transportation, food. Small expenses matter, but large recurring expenses can change your financial trajectory dramatically. If you can reduce a major expense by $300 per month, that's $3,600 every year. That's far more powerful than obsessing over whether you bought one $4 coffee. The money that made the difference. Now here's something that often gets ignored. The emergency fund wasn't built entirely from the $30,000 salary. There were also financial windfalls, tax refunds, bonuses, cash gifts, side income, money from selling unused possessions. Whenever extra money arrived, a percentage went directly into the emergency fund. This created a rule. Normal income supports the plan. Unexpected income accelerates the plan. That's an important distinction. You shouldn't build your financial life around money you might receive. But when unexpected money arrives, you can use it strategically. Instead of immediately upgrading your lifestyle, use part of the money to buy something more valuable. Financial security. The moment everything changed eventually, the emergency fund reached $1,000, then $2,000, then $5,000, then $10,000, then $10,000. And something strange happened. The money itself didn't change, but the feeling did. A small car problem no longer felt like a crisis. An unexpected bill no longer created panic. A bad month no longer meant reaching for a credit card. And then came the biggest milestone: 6 months of essential expenses. At that point, the emergency fund wasn't just savings, it was freedom. Because imagine having 6 months of essential expenses sitting safely in an account. You still don't want to lose your job, but you're no longer thinking, if I lose my job, I'm finished. You're thinking, if I lose my job, I have time to figure things out. That difference is enormous. The final mile. The last few months were psychologically harder. Why? Because once you have a substantial emergency fund, spending the money becomes tempting. You start thinking, I have $15,000 saved. Maybe I can afford a better car. Maybe I should take a big vacation. Maybe I deserve something, and maybe you do. But the purpose of the emergency fund is different. The final goal was reached by continuing the same system: automatic transfers, controlled expenses, additional income, windfalls, and patience. Eventually, 12 months of essential expenses were saved. Not 12 months of luxury, not 12 months of vacations, not 12 months of restaurant meals, 12 months of essential survival costs. And that distinction matters. The exact system. So let's put everything together. If you earn approximately $30,000 a year, here's the system. Step 1. Calculate your actual monthly take-home pay. Not your salary, the money that actually reaches your bank account. Step 2. Calculate your essential monthly expenses. Not your lifestyle, your survival number. Step 3. Multiply your essential monthly expenses by 12. That's your full-year emergency fund target. Step 4. Build the first $1,000. This is your starter emergency fund. Step 5. Create separate money buckets. Bills, emergency savings, short-term expenses, spending, long-term wealth. Step 6. Automate your emergency savings immediately after payday. Don't wait until the end of the month. Step 7. Reduce the biggest expenses first. Housing, transportation, food. Step 8. Create an additional income stream if possible. Even $200 or $300 per month can dramatically accelerate your timeline. Step 9. Send a percentage of unexpected money directly toward the emergency fund. Refunds, bonuses, gifts, side income, sold possessions. Step 10. Increase the target gradually. $1,000. 1 month, 3 months, 6 months, 12 months. And once you reach 12 months, you don't necessarily stop saving, you simply change the job of the money. What happens after you reach 12 months? This is where things get interesting. Once your emergency fund is fully funded, you may no longer need to keep sending every extra dollar into cash savings. Now you can begin redirecting additional money toward other financial goals: retirement, investments, debt elimination, a home down payment, education, business opportunities, or other long-term goals. The emergency fund has done its job. It has created the foundation. Now your money can potentially become more focused on growth. But remember, financial security comes before financial optimization. You don't build a skyscraper before building the foundation. The biggest lesson. The biggest lesson isn't actually about saving $20,000. It's about changing the question you ask yourself. Most people ask, "Can I afford this?" But a better question is, what does spending this money do to my financial future? Because almost everything has an opportunity cost. Spend $100 today. That is $100 that cannot be saved. Save $100. That is $100 that can provide future security. Invest $100. That money may potentially grow over time. Pay down expensive debt with $100. You may reduce future interest costs. Every dollar is doing something. The question is, what is yours doing? Think back to the person who started with a $30,000 salary. At the beginning, the goal seemed impossible. A full year of emergency savings sounded like something only wealthy people could achieve. But the system changed the goal. Instead of asking, "How can I suddenly save $20,000?" the question became, "How can I save the next $100? Then, the next $500, then, the next $1,000, and eventually, the next month of expenses." One milestone became another, and what once looked impossible became a series of smaller financial decisions. That's how large financial goals are often achieved. Not through one dramatic move, but through hundreds of ordinary decisions that point in the same direction. So here's my challenge for you. Don't close this video and simply feel motivated. Open your banking app. Write down your monthly take-home income. Then write down your essential expenses. And calculate your emergency fund target. Don't worry if the number looks huge. You don't need to save it today. You only need to know where you're going. Then choose your first milestone. Maybe it's $500. Maybe it's $1,000. Maybe it's 1 month of expenses. Start there. Because financial freedom doesn't begin when you become rich. It begins when you stop being financially helpless. If this video helped you see emergency savings differently, subscribe to EgoMoney for more practical lessons about building wealth, managing money, and making your income work harder. And before you leave, remember this. Your money is always doing something. It's either building your future, or paying for your past, or disappearing without a plan. The goal isn't simply to earn more. The goal is to make your money work with purpose. I'll see you in the next video.